Hello viewers, welcome to a new and a unique show, Income Fund Fundas, Simplifying Debt Market, hosted by yours truly Sunil Javeri and brought to you by Axis Mutual Fund. A lengthy query, but a very interesting query by a viewer. How does one invest in debt? What are the benefits of investing in debt through the mutual fund route? And why do mutual funds investments in the debt markets more volatile than investing through the traditional instruments? Without realizing, most of the viewers must understand that you already have investments in the debt space, which can be through public provident fund, it can be through bank deposits, corporate bonds, or what we know as non-convertible debentures or tax-free bonds. Other way of investing in the debt space is through the debt schemes in the mutual fund space. But what are the benefits of investing through the mutual fund space versus the traditional instruments which I have just listed out? Most important is the benefit of diversification. If you invest in a corporate bond directly, and if that bond gets downgraded or the company defaults on their principal or the interest rate payment, your entire principal can be at risk or at stake. As against that, if you had invested in the same corporate bond through a mutual fund route which diversifies into many issuers, and this can be just maybe 3 to 5% of the total exposure of that scheme, naturally that benefit of diversification will help you because your 90 to 95% of the other good papers will safeguard your principal and the total erosion of wealth which would have happened otherwise. The second benefit is the benefit of liquidity. If you try and sell the bonds or the traditional instruments which we've just spoken about in the secondary market, you may or may not get the right price for that instrument, or you may or may not get a buyer on a particular day when you actually need the money. As against that, there is what we call redemption facility available through the mutual fund space. You just have to give your redemption request. In the next few days' time, the money will be back into your bank account. So these are very important benefits of investing through the mutual fund space, but at the same time, as the question states, why is there volatility in the debt mutual fund space? That volatility happens because mutual funds declare net asset value based on the underlying security on a day-to-day basis. Interest rates can go up or interest rates can go down. There is a reverse correlation of interest rates and price of bonds, the underlying securities, which means if the interest rates go up, the price of the bonds can go down, or if the interest rates go down, the price of the bonds can go up, benefiting the investors. And that's what gets reflected in the net asset value on a day-to-day basis, and that's where you see that volatility creeping in through the mutual fund space. Also, there may be some illiquid papers, or those papers can be downgraded or default kind of papers also, and that also creates impact on net asset value on the negative side. But as against that, if the same papers get upgraded, naturally you will have a positive impact also. So all these are the elements which create volatility as far as the investments in debt space through the mutual fund is concerned versus the traditional instruments. But if you hold it for longer periods of time, that volatility seems to even out, and the investment experience for the investors in the debt space will be better and smoother also. I hope viewers have understood the meaning of how you invest in debt, what are the benefits if you invest in debt through the mutual fund space, and at the same time, why do debt schemes have volatility attached to it versus the traditional instruments. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.